Good morning, advisors, investors, and shareholders of APL, and welcome to Antipodes COVID-19 webinar series. This is Matt Dell. I'm a director at Pinnacle Investment Management. Pinnacle provides the non-investment related services which allow the Antipodes investment team to focus exclusively on managing yours and your clients' money. Joining us today is Antipodes Portfolio Manager Graham Hay and Antipodes Chief Investment Officer Jacob Mitchell. Graham will first discuss the outlook for the broader energy sector and then turn the focus to new energy as the world inevitably transitions to low-carbon energy solutions. We'll then hear a quick overview on the Antipodes portfolio before taking your questions live. So let's begin, and here's Chief Investment Officer Jacob Mitchell.
Thanks, Matt, and welcome everyone today. Old and new energy is obviously an interesting topic. I just want to say thanks to, it's really been the Commodities Industrials team that has put together this presentation, Commodities Industrials led by Chris Connolly and Graham Hay on hardware, obviously covering off the new aspect of the energy discussion. But let's start with the old. And I'm going to hand over to Graham just to take us through, obviously there's been some unprecedented sort of behavior in oil markets with the near-term futures contract on WTI turning negative recently. But the focus here is really not just the short-term outlook for demand and supply, but the longer-term outlook. So over to you, Graham.
Sure. Thanks, Jacob, and hello to everyone online. Look, yeah, unprecedented times. Who would have thought that an oil price contract could negative, but that's in fact what happened over the last few weeks. The backdrop here, though, is as this chart makes clear, is we are living through an unprecedented decline in the demand for oil. Through the first half of this year, we're now expecting demand to be down in the order of 15 million barrels a day. Now, for some sort of context, during the worst period of the GFC, we had a drawdown in demand of just under 3 million barrels a day. So what's happening at present is really unprecedented in modern times, and the thing that preceded that, which ultimately led to this negative situation with the WTI contract, was the breakdown in the OPEC alliance, whereby when that alliance broke down back in March, there was an agreement to increase production just as the worst of the COVID crisis was hitting, and that resulted in storage filling up very rapidly. And so because the contract for oil is physically settled, as the May contract drew towards expiry, with no place to store oil, you're actually getting paid to take oil if you could find somewhere to store it. So that led to that unusual situation of a negative futures price. Now, the price of the physical commodity is not negative. You'd be glad to know, and you can see the futures curve on the chart, which goes out to the sort of midterm for both Brent for futures is still relatively normal in terms of price and slope. So certainly an unprecedented sort of backdrop that we have today. But thinking more broadly around demand, it's worth just considering where demand comes from today and where we think it is likely to come from in the future. You can see the pie chart there on the slide, which breaks down oil demand by application, road gasoline being the largest, that's passenger cars for the most part. Air travel, which is obviously in the headlines, is a relatively small part of the oil space. But from a demand perspective, just if you draw your eye to the lower bar chart, you can see that the consumption of oil on a per capita basis in non-OECD countries is still very low relative to places like the US and South Korea. US today, for example, consumes around 13 barrels of oil per capita per year, and that number in China is about 3.5, and in India is only about 1.5. So, we see demand very much underpinned by developments in the non-OECD countries, and the long-term track record of oil demand has been growth of about 1.5% outside of these sort of macro shocks, one of which we're living through today. So that's probably how we see demand play out. We note there certainly will be headwinds, and they relate to decarbonisation programs that are underway in various parts of the world. But for the most part, those, even if they come to fruition, will result in a relatively modest decline in the demand for oil. To give you a number or some numbers around that, electric vehicles, perhaps the most bullish forecast we can find of the electric vehicle fleet at 30% of total units by 2030. If that were to play out, that would result in a roughly 2% reduction in aggregate demand for oil today. But that'll be spread out over 10 years. So the world has always tried to adapt to low energy solutions, and electric vehicles are another iteration of that. So we don't see a major dislocation in the demand side of the equation for energy.
That's great, Graham. And what stands out to me is just, the fact that, that we associate oil with passenger vehicles, because that's what we fill up with each day. But it's really just a quarter of the market. And secondly, just the fact that emerging markets are really the source of the majority of demand, and certainly most of the demand growth. So turning to the supply side, I mean, take us through what's going on this chart, and what the implications for supply are, given the lower price environment we're at least at the short end of the curve.
Sure. Well, supply is where we think it gets interesting. You can see that the chart there is what US production growth. The bar charts are the year-on-year change in production, which peaked in the middle of 2018. Over the last decade, the world has grown production by about 12 million barrels a day. The important point to note of that figure, however, is that 3/4 of that growth has actually come from the US shale industry. And us, along with many others, have had concerns around the economics of that production for some time. In the first phase, capital markets were willing to sponsor that, but in recent years they've become much stricter around what shale needs to achieve in order to attract investment dollars. And the truth is that over the period from 2010 to 2019, the industry has roughly spent 125% of every dollar that they've taken out of the ground in terms of cash flow they've had to put in to generate that output. You do that for a little while if the capital markets will sponsor it, but it's not a long-term sustainable situation. So you see in that production growth out of the US was already coming down as we headed into this crisis, and clearly the impact of COVID-19 has accelerated that decline, and we're expecting that CapEx in the US shale patch this year will be down in the order of 50%. The chart that's before you now gives you a picture of the recent history, so you can see that production, CapEx, I should say, peaked in 2014, coincident with the oil price, has stepped down from those levels, and we're expecting another 30% reduction based on what we've heard from companies as they reported their Q1 results, another 30% cut CapEx in 2020. So look, that sets up the next 5 years. You can see the bottom here for base level production as well as newly sanctioned projects. And the picture is one of supply continuing to decline. And the forces at play from capital markets that were already evident have now been accelerated by COVID. And so our expectations are that over the next 5 years, you'll have a very limited supply picture in oil. And of course, that sets up the commodity to be quite interesting as economies normalize and demand recovers to a normal state.
So look, in terms of investing in the sector at Antipodes, we are ultimately looking to invest in companies that are resilient, offer us multiple ways of winning. Now, probably back when oil was $100, many investors would have, found, plentiful opportunities in the sector. Now, there's a lot of skepticism around whether you can make any money in the sector. Take us through why you think Equinor qualifies as a resilient investment.
Sure. Yeah, so I guess the first point to make is, in a fragmented commodity industry like oil, what are the things you're looking for? Well, frankly, there's two things you're looking for. What is the position of that company's? What is that company's position on the cost curve? And secondly, what is the track record of capital allocation? And those two things really go a long way towards making a successful operator in this sector. Equinor, Norway's largest oil company, is, we think, an example of that. They have a track record of being way down the cost curve with very smart capital allocation decisions over a long period of time. That gives us exposure to upside to oil price if our supply demand scenario plays out. But in addition to that, the company have, over the last number of years, have been developing a renewables portfolio that we think is underappreciated by market. This is an offshore wind development that allows the company to supply very low carbon emission energy back into the system. And on a standalone basis, these assets have become very valuable in the market in recent years. And when we benchmark Equinor's wind assets to standalone entities, we think it could be worth as much as $15 billion or 25% of the enterprise value. So that makes it interesting on a number of angles. And you can see the chart, the lower of the two charts there, shows Equinor's greenhouse gas emissions per dollar of revenue is one of the lowest in the industry. And of course, as you mentioned, Jacob, the valuations of these stocks in recent times have become quite cheap on average, and Equinor is no exception, with the stock trading at a near year low on relative price to book. So it gives us a number of things. The interesting other angle here is that a lot of the major projects at Equinor are coming into harvest mode, and that means that cash flows coming out of those projects will be very strong over the next several years. So we think pretty well underpinned by this story, starting dividend yield of 4%, and very attractive set of assets across both renewables and conventional.
Yeah, it's an interesting proposition at $35 oil, where obviously we don't believe oil price can stay at that low forever, given just the capital rationing that is taking place. In an environment where traditional dividend stocks, investors asking questions around the sustainability of dividends in some of the traditional sectors, like financials, like certain parts of retail. I think the positive aspect of the Equinor story is that we believe that dividend is defendable and sustainable, and ultimately, at a $40 oil price, significantly covered. And if to the extent that oil prices get back to $50, we're talking about a company that's trading on close to a 10% free cash flow yield. Look, we're going to shift gears and bring you back into more familiar territory as a technology hardware analyst. Discuss the new energy component of the presentation. Look, what's going on this slide? What's the message we're getting across?
Yeah, look, so the thing we're trying to convey in this slide is really the fact that Europe has a unique set of unique backdrop that could result in a major renovation program that builds on efficiency and decarbonisation over the next decade. We're all aware of the weak economic backdrop, but there's also a political consensus in Europe that these types of investments around efficiency and decarbonisation are good for both the economy and the long-term prospects of the region. So we're just trying to show some of the things that have been announced and contextualized the aggregate of those projects relative to some other major programs that have preceded it. And then I think, from an investment standpoint, it's worth thinking about how you build exposure to these types of themes. And for us, it's really three areas. It's really components, it's systems and software, and then it's delivery and distribution. And if you go on to the next slide, you'll see some of the logos of companies that we have built exposure to across those three enabling industries of what we're talking about.
So, what's the why do we need these? If we start off on components, why do we need, higher performance components, and basically how do we get exposure to that trend?
Yeah, so semiconductors, they are the basic building blocks of a lot of technology. The industry is very large and diverse today. Our interest is on a particular subset called power semiconductors, which are used to condition and control electrical current inside of a system. And what is really happening, the demands of that system, or systems that help us move to low carbon environments, are inordinately greater than the ones that have gone before it. And that puts different types of pressure and performance requirements on the components. The chart here, the table here, I say, is some data provided by the US Department of Energy, and it highlights the CO2 savings available as you introduce these types of specialized power semiconductors into different systems. For example, renewable energy systems, industrial motor drives, data centers. And probably most visible of all right now is hybrid and electric vehicles. The CO2 savings of doing that are very substantial. And so it's probably worth, dwelling on electric vehicles because they are such a visible part of the near-term story on decarbonisation. And the chart that we're now looking at is there's a few things going on here. The first point to make is that electric vehicles, of course, it's somewhat back to the future. These were some of the very first commercially available passenger vehicles on the road. And we've got an example of one called the Baker Electric, long since forgotten, but at the time was a leading innovator in its industry. And of course, the modern version of that is the Tesla Model S, delivered in 2019. And look, again, I think it's worth just pointing out the trend that underpins the demand for electric vehicles. The International Energy Agency, in their 2019 survey, pointed out the fact that the global EV fleet emitted something like 38 million tons of CO2. But that, whilst that sounds like a lot, in fact, it's a save of 40 million tons had that same fleet been powered by internal combustion engine. So you can see that there are very substantial savings available through electrification of the fleet. And various regions, and particularly Europe and China, are really promoting electric vehicles as the way forward.
So, take us through, how we get exposure. I mean, we like to, once again, it's always good to invest at the top of the food chain. So,
Right.
what are some of the investments that follow from this?
Yeah, look, a company that we've been involved with since 2016 is ST Microelectronics. A company is headquartered in Geneva, so it's literally the Switzerland of the industry, which may become important as trade becomes more of an issue. But ST have been developing these important power semiconductors for over a decade. And they have built very important relationships with the leading OEMs, such as Tesla. And those components are aligned into the inverter and the onboard charger of these electrical systems. And just to give you a flavor of what's different with electric vehicles, we go from a 12-volt battery system to battery systems that can be in excess of 400 volts, and the requirements on the components that support that become inordinately more difficult and require a different type of material to enable those components to perform. And ST Micro are the company that we've identified that is at the top of the food chain, that really lead the industry and are benefiting from the growth in electrification of the vehicle fleet. They have today over 30 design wins, and the most visible of this is Tesla, where they have almost 100% market share. So we think it's a very well-positioned company to benefit from this trend.
And switching focus to another beneficiary, just very quickly, our investors know the Siemens story quite well, but what are the key points we want to make here?
Yeah, look, Siemens, a well-known German industrial conglomerate. The company over the last decade or more have been going through a program of simplification. They've been transitioning their business model away from projects towards efficiency. But most importantly, from a portfolio standpoint, almost 100% of the portfolio is geared to efficiency in some form, whether that's industrial processes, raw materials consumption. And so we think the portfolio plays very well to some of the programs that we've been talking about earlier in the slide presentation. It also gives us a very attractive starting yield, close to nearly 5% today, and has important leadership positions in its core categories as well. The current recession notwithstanding, we think is very well positioned to be a beneficiary of this investment program.
So why don't you wrap it up on the conclusions from old and new energy?
Yeah, sure. Look, so we've covered a lot of material. Probably the key point to leave you with is that supply rationing, which is what we talked about, really sets the stage for the next oil price cycle. COVID-19, as bad as it is really an accelerant to the rationing process. But we need to be conscious that there is an ongoing transition towards low carbon solutions away from fossil fuels. And as an investor, you really want exposure to the guys that are enabling that transition to happen. We've identified some of those in the presentation, and they really encompass components. They encompass systems and software, like a Siemens, and then it's some of the distribution and delivery mechanisms, companies like RWE and EDF in France. And you can see on the slide at the bottom of that, the table at the bottom of the slide, you can see how we're positioned across a number of those categories: energy enablers and infrastructure. It sums to about 13% of the global Antipodes global fund today. And so we have quite a decent exposure to this theme playing out.
And as a cluster, I think what's important for our shareholders and investors to recognise is that there's a degree of non-correlation across those exposures, which is important, we believe, in terms of managing risk. Look, switching focus to just a broader outlook update. When we think about how COVID-19, how the narrative around COVID-19 may evolve, it's important to make the distinction between testing for infection and serology-based tests for antibodies. The focus to this point has been testing for infections. You can see on that table on the right, we're switching the focus to population level statistics. So, and we're selecting countries either because of their size or because they've done a lot of testing. Because what we note is that the more you test for infection, typically the more you find it. So not talking about antibodies, just infection. So the average across those populations for infections is about 0.8%. Then when you look at the fatality rate per 10,000, it's running at roughly 5. Now, to give that context, seasonal flu, that's about 5 times the level for seasonal flu. But seasonal flu has a higher infection rate, if you like. Now, the question that's emerging, or the issue that is emerging, is potentially, infection rates have been much higher than what we've detected. Some of the early serology-based tests imply that they may be up to 5 to 10 times higher than the detected rate. So a lot of infections remain asymptomatic. The person does not feel in any way sick. So that sort of has implications. It potentially means, in open, very large open economies, it will be difficult to eradicate COVID-19. So we think the narrative will switch to a lot more serology-based testing, and it will be learning to live with COVID-19, potentially as a seasonal sickness or illness. And also, with obviously a lot of focus on treatments, and remdesivir, which we have exposure to in the portfolio via our holding in Gilead, is showing some signs of really reducing recovery times. But we are going to see, a lot more discussion around and urgency in treatments, and that will be, worth monitoring very closely, because it will impact the market's view of not just the duration of lockdown, but the type of reopening that we may have. So changing to the next slide, stimulus, fiscal and monetary stimulus has been enormous. And it is, for context, we've put that by different countries relative to their 2019 fiscal position. So, we're highlighting that we think certain, certain countries or regions have come into this in better fiscal position than others. And I think it's a key question is, to what extent the US can sustain this level of income stimulus, given the the expanding government debt position relative to the strength of the dollar. The credit markets, even with support from the Fed, we believe that the junkier component of the corporate credit market will remain quite fragile. And so, look, the focus, or we think, the way to think about investing in this environment is to think about stages of lockdown and recovery. So stage one, massive income stimulus. The beneficiaries are, the work from home, DIY, food delivery, e-commerce. Stage two will be a question of transition from income stimulus to more infrastructure related stimulus. A real focus on supply chain localization, not just in technology, but if you think about pharmaceuticals, the APIs that go into pharmaceuticals are almost exclusively supplied by China. That is clearly going to come into the reference of, an American political system that is becoming increasingly isolationist. So bringing back, relocalizing supply chains. So looking at the monetary side or the fiscal side, issues that are emerging, clearly, the technology rivalry between China and US is re-escalating. The Democrats favor state bailouts over tax cuts. The question will be, will they find common ground, to bring about an infrastructure program? And then the same applies for Europe. Is there enough common ground for a major infrastructure stimulus, primarily led by decarbonisation investment? Life won't revert to the status quo. We think people will be slow to, even when economies open up, they may be slow to go back to some of their behaviours. Corporates will see this as an opportunity to cut costs. Look, there's some pretty obvious, I think, longer term trends that may follow from this, as we've noted on the slide. So investing in this environment, when you think about our portfolio positioning, the top row there, we believe are exposures in the portfolio that are cheap relative to their growth. They have a higher growth profile to them, or more defensive growth profile to them. And they do well in stages 1 and 2. They're doing well at the moment during this, the early phases of income stimulus and social distancing. Look, stages, the second row are more likely to, the performance or outperformance will more likely accelerate as we transition less about income and more about investment. And that's been the focus. The first two squares, new and old energy and secular industrials, have been the focus of today's presentation. Our exposure to those, let's call them more recovery type opportunities, will increase if we get greater confidence around the emergence of proper infrastructure stimulus and a more certain pathway to opening up. So that really brings us to the overall portfolio exposures. We have time for we do have time for questions, so I'm going to hand it over to Matt Dell.
Okay, look, thank you, Jacob, and to Graham as well. Why don't we take some questions? You can ask questions still. There's a Q&A button at the bottom of your screen, but I'll kick things off. And firstly, Jacob, we know that you benchmark unaware, but how much of an active investment do you have in energy?
So as the slide showed, including our producers and the services sector, it's around that 5% level. We also have a short, which brings that back to about net 4.5. The question versus benchmark is an interesting one, because energy and energy services as a percentage of the benchmark are really the lowest they've been in living memory. So does the benchmark really reflect the opportunity? Look, there's no doubt that COVID is going to impact, and air travel, we believe, will be a stage 3 discussion. So it's not as if, and about 10% of energy demand is related to air. We think the recovery out of this will be moderate. It will be slow. So we don't want to be all in on energy, and we certainly want to be in the better, in the lower cost producers. So we have a relatively low beta exposure to energy by design. So it's moderately active, but it's not aggressive by any means. And our focus is, ultimately, we see energy as a supply story rather than a demand story. We see it as solid dividend yield, whereas new energy is about, buying companies that are secular growers that are misunderstood.
Jacob, a couple of questions here on currency. So with fiscal deficits blowing out, what are your views on currency?
I think it's all about the dollar. I think, in an environment where the US is running an extraordinarily loose fiscal and monetary policy, which is, certainly good for asset, potentially good for asset prices, and, has certainly helped us in this stage 1, 2 exposures that we've had in areas like, exposures like Facebook and Microsoft, and in the pharma exposures. That's where that monetary stimulus is going at the moment. For the currency, I think it's the opposite. I mean, I think it's about a weakening dollar. I mean, that very loose monetary policy potentially takes pressure off emerging markets. Emerging markets, currencies can strengthen, I think, against a weakening US dollar. And it allows those parts of the world to loosen policy. So we don't see, outside of maybe some of the oil exposed EMs, we do not see a external crisis scenario emerging. Now, our exposure to emerging markets is very much a Chinese exposure with one stock in India. So it's a very focused, we see China as a sort of almost like a market in its own, hardly emerging. It's via some of the higher quality consumer and internet exposures in that market, we think, which are cheap relative to their growth and dominance.
There's a couple of questions here, Jacob, on the oil price. One of them is, given our views on the current low oil price and its unsustainability, do you have a view on inflation, given the historic relationship between rising oil prices and inflation?
So oil, look, that has been the historic case, and I think it is going to be, we are potentially, in the short to medium term, still in a fairly deflationary environment, which is, it's going to be probably more of the same in terms of low rates. Style preference is still going to be quite growthy, but that gets increasingly dangerous, because I think that style preference gets more and more expensive as every day goes by. The issue is, how do you fund these deficits, and what risk does do asset markets start to price into lending to governments that have relatively high debt to GDP as a starting position, with potentially an open-ended fiscal deficit? I mean, how do investors think about the US fiscal position? It was pretty open-ended coming into COVID-19. There didn't seem to be any pathway back to a surplus, and now it's extraordinarily open-ended. So a higher real interest rate may be on the cards. You know, inflation, deflation means real rates are going up or else equal. So, you know, that does impact the discount rate. And there's, you know, the duration growth chasing is very dependent on discount rates staying low. So that's you know, definitely worth monitoring.
Jacob, there's a couple of questions here, just more broadly on the fund, but the long-short fund in particular, and the net exposure. Has the net exposure been moving much around lately?
Just give me, we'll go straight to the slide so we can answer that. God. Excuse me. So here we go. So you can see here month by month how we've moved the net. So we've given the net, which includes the credit default swap, credit protection we've had in the portfolio, and then the net equity, which excludes that number. So as you can see, coming into February, and you know, we took down the net primarily through the tail risk hedges, and then, you know, we've built that back up. So from 56% to let's call it just under 69% at the end of April. And you can see the net equity exposure has risen by about 10%. That, you know, that is been a function of, you know, bringing up our long as we've had opportunities emerge through the sell-off, cutting some of the shorts, and certainly cutting out the tail risk hedges that have, you know, that protected the portfolio very well in the March quarter.
Okay, look, just in the interests of time, we may just wrap it up there. I would just see a few participants dropping off. There's been quite a lot of questions today, so if your question wasn't answered, we will certainly come back to you after this with an answer to your question. And the team is also available for calls as well from time to time. That brings us to the end of today's webinar. You can access a replay of the webinar by visiting Antipodes website, that's antipodespartners.com, and clicking on the Insights tab, if you just give us a few hours just to get it up there. Just a reminder also that our next webinar will be in 4 weeks from today. That's Thursday, the 4th of June. So look, thank you for joining us again. Thanks for your interest and your support of Antipodes, and I hope you have a good day.